thank you to all for attending, because these events are nothing without an audience and without people showing an interest in what's going on in our local environment. And so thank you for that. This is one of a series of events which obviously the Chamber of Commerce are hosting this month. And as part of that particular series, I just wanted to have the opportunity to bring your attention to the business conference, which is taking place on the 16th. That's in association with the Worcestershire Let, and also the West Midlands Expo in association with Hewitt Recruitment, that is taking place on the 22nd to the 26th of March. 5 days of virtual networking across the West Midlands, where Worcestershire and Herefordshire businesses can promote themselves and can visit that particular virtual exhibition. So there is lots going on, and I would urge you to follow the events pages, follow our LinkedIn pages as far as the Chamber of Commerce is concerned, because sometimes that can be the fastest way to find out the information that you need. And one final request, because there's still a couple of days left, if you've not had the opportunity to fill in the quarterly economic survey, or the QES as we like to call it, there is still time to do that. And we've had over 400 respondents so far, and that's 400 people who have made the decision to try and help us with our information gathering and help us with the way we can perhaps mold our policy and lobby people as we move forward and lobby government, local and national. So a number of things there that if you would be able to have a look at, that would be absolutely fantastic. I would like to thank you, obviously, as I have done. I'd like to thank the Chamber team, because these Chamber events, behind the scenes, there's an awful lot of work that goes on to make them happen. So a huge thank you to Yaz and to the Chamber team, and also to the policy team, to Arjun and to Lisa, who are responsible for the policy work that goes on as a result of some of that activity that I've already mentioned this morning. A big thank you to Bishop Fleming, who you will hear from after me, to support us with this event this morning. One of about 8 or 9 events that Bishop Fleming are actually running around the UK this morning. So we are part of a big network of businesses and organisations that are taking advantage of professional advice that is out there, and opinion and information which is available. So Rob, if you'd be so kind, could you share the screen and put my first slide up, please, or my only slide you'll all be very pleased to hear about.
That comes through, Robert?
I can see that, thank you. If you could just go on to my... Perfect, thank you very much. So in terms of the Chamber of Commerce's reaction to the budget, at about 4:30 yesterday afternoon, I felt as if I had a fair old grip of what was going on with the budget and the various announcements. By about 9 o'clock, I was a little more confused, and having listened to the radio this morning, I think that there's still much to listen and much to learn about with regards to various reactions to that. But I think what's important with regards to the budget, the devil is sometimes in the detail, but you know, it represents, we as a Chamber of Commerce are representing our members. We have 1,400 members across Herefordshire and Worcestershire. We have many partners that we work with, and then there's the wider population of the 2 counties, which as an organisation we have a responsibility to work with. Some of our members have 1 member of staff. Some of our members have thousands of staff. And so as a result, it's going to affect different people in different ways. But I guess we largely welcome the spirit of the budget, and that comes in 6 areas. And those 6 areas are ones which we're going to be working on over the next year with regards to our Chamber activity. So in terms of COVID recovery, obviously the announcement with regards to furlough has been welcomed. The vaccine rollout and the fact that that is working quicker than anticipated, and the resulting forecasts with regards to growth are encouraging. There does remain that issue with furlough that as businesses perhaps come up to capacity, will they have enough staff to reach that capacity, and will the cash flow be there to actually support those staff coming back? We welcome the restart grants and hope that they can be distributed quickly, but also we would like to perhaps see, and this is evidence some of the discussions that we have, that as well as support for B2B business, there is support for B2C businesses as well. In terms of cost to business and overhead expenses, obviously the information with regarding the rates and the extension of the holidays with rates is welcomed, as is the VAT plans on some of the industries which are covered by that. In terms of international trade, the free ports announcement is an interesting announcement there. It may not affect us directly, but it may encourage investment that we can and our members can actually benefit from, and also help the supply chain. There are still stories of increased costs and increased delays with regards to international trade, and we'll continue to work towards those. In terms of skills, obviously very positive news with regards to the apprenticeships and the money available for bringing apprentices into your businesses. And I think that this whole opportunity to look at apprenticeship is a bit of a correlation with the returning employees that we have into our workplace, that making sure we have the skills there, but also making sure that we have the people that can do that. In terms of technology, we're obviously very pleased to see that there is an opportunity perhaps for the visa rules to be amended so that we can attract some skills in from overseas. But more importantly, I feel that there is skills in our area of Hereford and Worcestershire that we can exploit and perhaps be able to help people with that. And in amongst the taxation arrangements, perhaps the opportunity where investment in technology may well be able to be offset with regards to some of tax. And in sustainability, we're obviously very, very happy to see that there is £15 billion worth of funding towards the green bonds and the carbon capture and activities that can be around that sustainability area to help everybody in our Chamber of Commerce area. So it's true that there are indeed global, national challenges, the global and national challenges that cascade down to local level. Our responsibility as a Chamber of Commerce is to support you all as we move forward with these particular measures. So now what I'm going to do is I'm going to hand over to Rob Pearce from Bishop Fleming, who Rob and his colleagues this morning are going to talk us through some of the changes that they see from the areas that they deal with. Over to you, Rob.
Thanks, Robert. Good morning, everybody, and it's really appreciated you coming on this morning. It's not normal COVID or pandemic behaviour to come on at 8 o'clock and listen to all things tax, so it's appreciated. So this is my 7th year in a row where I presented the morning after the budget. The first, albeit online. I'm normally dressed up in some form of fancy dress at the cricket club or the rugby club, but it was an interesting budget from my perspective. I've always been able to predict to an extent what the budget's going to say. We've always had our slides written a few days in advance and just need a few tweaks, but this was quite different, really. A lot's in the media, wasn't there, in terms of capital gains and wealth tax, etc. It drove huge amounts of activity in the corporate world, and if there's any corporate lawyers on here, I'm sure that, well, they're probably still asleep at the minute, to be honest, because they've been so busy. So many owner managers have been doing corporate transactions, selling, transferring shares, etc., the lead up to yesterday, with a view of still getting and attracting some favourable tax rates, and the thought it's going up. And the bottom line is that that it hasn't, and capital gains is very much still is still as it was 2 days ago, to be honest, and I'll touch on that in a bit. Originally, I thought, oh, there's no way is Sunak going to hike the taxes at the moment. It's just not the right time, as where we are in the pandemic. And then Boris's roadmap came out, and I thought, actually, there's more optimism in the air, and it might be a good time to do it in Sunak's eyes, certainly not mine. But yeah, what we actually got was some interesting points, really, that we'll cover clearly. What is clear is that there is still an absolute need for COVID support, and the government are very much still pressing on with that, which is good. So, quick one on the economy. Some huge numbers were bandied around, obviously, yesterday. The UK borrowing at a record high of 355 billion. That's predicted to go down to 234 billion in borrowing next year. And the thought is that we'll return as an economy to pre-COVID growth levels by mid next year. I'm actually really struggling to see how. We've got over 100 billion of debt repaid within a year. Most taxes are frozen and corporate tax is increased that we'll talk about, but that increase doesn't kick in until April 2023. So if I'm honest, I'm still a bit bemused as to how that debt is going to be repaid. So this is my daughter's favourite slide, by the way. She was gobsmacked when she saw me prepare this last night. But anyway, I think the vast majority of taxes, as you may have found out, have been frozen for the next 5 years, until 2026. And 5 years from a tax perspective is really quite a long time. This might seem a good thing that taxes aren't going up, but it's seen by many as actually a hidden stealth tax. The concept of fiscal drag. As wages rise, a higher proportion of income is paid in tax. Income tax, for example, so the personal allowance currently is 12,500. That goes up by £70 from April to 12,570, and then frozen there for 5 years. Similarly, the basic rate tax band limit is now 37,500. That goes up £200 as well, this from April. So from April and the next 5 years, anyone earning over 50,270 is into the higher rate. It's predicted that about 1 million more people will be paying tax over those 5 years. And by 2026, it's going to create a stealth tax of another 8 billion, which is a huge number. But again, how is that going to dent these debt repayments that we're having? Fuel duty, well, that's frozen for the 11th year running, apparently. The pension annual allowance, so you can still put up to 40,000 gross contribution into your pension in a year. The pension lifetime limit, that's a little over £1 million that you can have in your pension pot without being penalised from a tax perspective. That's frozen. So that will need a little careful management over the next 5 years in terms of whether, if one's got the ability to withdraw some, is it the right time to do it, as opposed to as funds grow, or funds hopefully grow, it's going to keep going over that limit. National insurance, frozen. The VAT threshold of 85,000, frozen. Inheritance tax, again, a year or two ago, there was talk about some significant changes to that regime. That's frozen. So the first 325,000 of a deceased estate is tax-free effectively. There's a further 175,000 exemption if the individual is passing their main residence down to a direct descendant. So one can get up to £500,000 off their estate, and that's frozen. And the really interesting one to me is capital gains. So as I said before, massive talk about capital gains being increased to income tax rates, etc. But the only mention was the annual exemption, and that, you guessed it, frozen for the next 5 years. So the annual exemption being the first 12,300 of capital gain that someone, a taxpayer, can make in a year is tax-free. Anything above that is subject to capital gains rates. So again, capital gains rates are still at the levels they were before, which are relatively low. Entrepreneurs relief, which for some reason they've changed the name to business asset disposal relief, that is still as it was, that you can get 10% tax rate on the first million of gain in your lifetime is still very much applicable. Now, the cynical side of me thinks that corporate tax, as we'll go on to, has gone up. They've commented that everything else is frozen. What they haven't commented on is the capital gains rates. So does that mean they're going to pave the way to increase those in the autumn or next year, etc.? The cynical side of me says yes, probably, but we'll have to wait and see. As I said, company taxation has increased, and this is probably from a tax perspective, the area that has been most affected, good and bad. And I'll pass over to my colleague Dan, who will talk you through it.
Thanks, Rob, and good morning, everyone. Yeah, as Rob said, whilst a lot of the other tax aspects have been held in stasis almost as a result of the budget, corporate tax in the UK has seen a lot of changes, both proposed and immediate. The headline one that I'm sure a lot of you will be aware of already is the introduction of a 25% main corporation tax rate. Of course, quite a stark increase from the 19% that we've been used to for the past few years or so. And in massive contrast to the proposed rate of 17% in a pre-COVID world, which is very much now, of course, off the table. It's of course worth mentioning that the 25% CT rate will only apply to companies with profits of 250,000 or more. So there will still be plenty of owner managed businesses who will continue to pay at a 19% rate where profits are below 50,000. There's an aspect of almost going back in time in terms of the treatment here, because what's happened is, as a result of these proposed changes, there's going to be a marginal rate effectively where you've got profits sitting between those two limits. And that's going to open the door to a hell of a lot of planning opportunities in terms of loss relief, group relief, etc. So we've gone very much backwards in terms of tax simplification. We're going away from one main rate back into the world where there are marginal rates based on your level of taxable profits. In much the same vein, associated companies rules are changing as well. Again, reversal, we're going backwards in a sense. So currently, when you're considering associated companies, you're looking at companies within a corporate structure where there's 51% beneficial ownership of a company to another one. What this change will do is it will effectively widen the scope of companies that are considered associated by looking at the absolute top level of ownership, so individuals. So what you could end up having is companies which are not within the same corporate structure as each other, but share the same common ownership, now becoming associated for tax purposes. And that has a number of knock-on effects, really, in terms of looking at bandings for quarterly instalment payments. So currently, companies which have over 1.5 million of taxable profits have to pay their corporation tax in advance in instalments, and that 1.5 million figure is divided by the number of associated companies. So if you're widening that net, you are accelerating tax payments for a large number of companies. Likewise, with the profit figures that we're quoting above in terms of figuring out your CT rate, again, those profit figures will be divided by the number of associates. So as you can see, the scope has been widened to drag a lot more companies into paying a lot more tax a lot more quickly. Of course, this doesn't come into effect until April 2023, and together with some of the capital allowance changes coming in, this will give companies quite a lot of time to prepare and to plan accordingly, so that the higher rate is mitigated. Yeah, next slide, please, Rob. So
back on me. Sorry.
Back on you. Straight back to you.
Crikey, Dan. Annual investment allowance. So ordinarily a very lucrative scheme. So for businesses that are buying qualifying plant and machinery, particularly, you can get 100% tax deduction in the year. And ordinarily that limit is only applicable to the first 200,000 of spend, but the budget has confirmed that the annual investment allowance limit is actually now extending and still will be 1 million until the end of this calendar year. It will then reduce back to 200. So on the face of it, a business can spend up to £1 million and get £1 million tax relief in that 1 year. And that is fantastic in terms of crunching the numbers and working out what the tax relief is really quite lucrative. One interesting point here I've got on the final bullet really is that where you have an accounting period that straddles the end of this calendar year, for example, a 31 March 2022 year end, then the timing of this expenditure is quite important because you have to prorata the limits, etc. So that you just need to give that some thought so you're maximising the claim. So that's annual investment allowance. And then one of the big shockers of yesterday, well, certainly a shocker from a tax nerd perspective, is the super deduction. And well, it's not funny, but in the tax legislation, they're actually referring to it as the super deduction, which is quite interesting. So this absolutely blows AIA out of the water to the extent that it will probably hardly ever be used these days. And there appears to be no limit to the expenditure. So businesses that make qualifying capital purchases from 1st of April 21 to 31 March 23 are entitled to this super deduction. The super deduction is the expenditure or the kit that they're buying needs to be brand new, can't be second-hand. And for main rate expenditure, which is your plant, your equipment, commercial vehicles, etc., not cars, not motor cars, you're getting 130%. So before you got 100% on the first million, you're getting 130%, which from a tax perspective is really significant. It effectively means you buy a new tool for £1 and you're getting 25p back in that pound. Effectively means it's obviously cost you 75p. And that's really quite significant. Any expenditure on what we've got here on new special rate expenditure, what we mean by that are your integral features. So mainly fixed plant within properties such as hot and cold water systems, lighting, electrics, lifts, thermal insulation, etc. Anything that doesn't have a life of 25 years or more. Instead of 130% deduction, you're getting a 50% deduction on that. Interestingly, in the absence of an annual investment allowance, you would only be getting a 6% deduction every year on that. So again, massively helpful in terms of reducing that tax bill. From a planning perspective, I've already mentioned that there's 25p back in the pound on the main rate expenditure, but when you're looking at costings, etc., and you really need to be factoring this in to see what you can afford at the time, etc. As I say, interaction with annual investment allowance, interesting. From a main rate expenditure, so your equipment, your plant, your commercial vehicles, you can forget AIA because the super deduction is here for that period. But when you look at special rates, actually annual investment allowance can be claimed at 100% versus 50% for the super deduction. So there's a bit of interaction of a bit of batting order to be considered here on what's the best claim to be making on what particular expenditure. Timing's really important. You can see here it's for expenditure from 1st of April 21 to March 23, but the question is when is the actual tax point of the timing, and that will slightly depend on the type of contract, the type of hire purchase, for example, or cash payment with extended credit terms. So that just needs a bit of thought. Similarly, with AIA, if your year end straddles 31 March 2023, there's a pro rata relief hybrid rate to consider. So its timing is again key for that as well. But yeah, from our perspective, that's a great deduction, and one that will hopefully stimulate investment, and yeah, is very welcome. Interestingly, it's due to finish the day before the corporate tax rate goes up to 25%. So what businesses are clearly being encouraged to do is invest hard up to that point, and then if that creates any form of tax shelter or losses, then the strategy could be to use those losses into the following year when rates are higher and capital expenditure is a little less.
There's also been some additional flexibility on corporate tax losses. The flexibility for losses has been quite prominent over the last few years. So from 1st of April 17, you were able to group relief carried forward losses. And generally speaking, I think due to the sort of economic climate we're in, the ability to use your losses has just widened considerably. Essentially, what you can do from for periods ending between 1st of April 20 and 31 March 22 is, instead of being restricted to offsetting losses against both other current year profits or profits of the previous 12 months, the new rules will basically allow you to say, okay, we'll offset against current year and then the previous year, and then whatever trading losses you've got left over, capped at 2 million per additional 12 months, can be offset against those for the 2 years going back, but it can only be against trading profits only. Whether or not, how beneficial this will be to companies really depends on their requirement for cash. Because if you've got a bank of losses, of course you could take advantage of this, go back if you've got trading profits in previous periods, recoup tax that the company suffered at 19%. That's great, and it might, and in certain situations it might be that that's by far the best way forward. But conversely, bearing in mind you've got a potential 25% CT rate coming in April 2023, it might be more beneficial to actually stockpile these losses, carry them forward, and if the company's got a decent chance of paying corporate tax in the future, offset those losses against profits in future periods and achieve tax relief at a considerably higher rate. So this is a positive, you know, to give companies this flexibility. But in terms of practically, it will very much depend on each company individually, because, like I say, going forward with the tax rates going up, losses become considerably more valuable in the future. This is a topic that's together with the same treatment applying to certain dividend payments from the EU member states into the UK. This has sort of been lost a little bit in terms of in between the Brexit noise and more prevalently COVID. This interest and royalties directive was introduced in 2003 to try and smooth over interactions and transactions between group companies in different EU member states. Of course, UK being a part of the EU at that point. From 1st of June 2021, with this directive being abolished, what will effectively happen is the exemption applying on payments of interests and royalties from UK to EU companies will cease to occur. The exemption being that there typically was no withholding tax on payments of those type to other member states. Without that exemption applying, life's got a little bit more complicated, because now you need to consider the double taxation agreement between the UK and whichever other EU member state the transaction is that you're transacting with, whether that be France, Spain, Italy, whoever. And what you'll find is that there will be withholding taxes payable on amounts where payments are made to companies in those countries. So from a planning perspective, if these payments are being made currently, then it makes sense. It could make sense to accelerate them pre 1st of June of this year to avoid that sort of withholding tax requirement. But going forward, if payments continue to be made, it's being aware of the obligations that the group will have in terms of reporting withholding tax payments and understanding, the quantum of those as well.
Thanks, Dan. I think from my perspective, I think the key takeaway message is that if any businesses are part of an international structure of some description and pay or receive interest and royalties and indeed dividends across internationally, then it just needs a review now, and don't automatically think that what was this before is going to apply now.
Yeah, it goes back to the sort of branch versus subsidiary scenario consideration, and I suppose as a result of this change, that the gap, typically the subsidiary has been more tax efficient, but that gap's probably narrowing as a result of these changes.
Thanks, Dan. So residential property, always a massively discussed topic in any budget over the last sort of 5 years. It's been relatively, hardly anything was discussed, to be honest. But there's nothing groundbreaking here. I just wanted to cover 4 very relevant points that aren't new from yesterday, but are still very topical, and ones that may have a bit of a misconception in the economy. First being, when principal private residence, you sell your main house and you've lived in it throughout, any gain you make is tax-free. It's free of capital gains tax. We all know that. But if you had a period of non-occupation for a particular reason, then on selling it with a gain, it doesn't necessarily mean that you have got a tax-free gain. You might have some tax to pay. HMRC always deem, whilst you might not live there, but the last 9 months of you living there, of you not living there, of your ownership, that you're deemed to be living there, so that's exempt to that period. Capital gains tax rates for resi properties are still at 18% for basic rate taxpayers, 28% for higher rate taxpayers. Any buy-to-let landlords out there will very much know of the mortgage interest restrictions. So this is where you only get the buy-to-let landlords only getting a basic rate tax deduction on any mortgage interest payments it makes. And this is pushing many people into higher rates of tax, etc. That's still there as it was before. An interesting one that came in last year and got deferred a little bit and relaxed a little bit due to COVID, but not anymore, is that where the individual sells a residential property and it isn't their own home, then they're obliged to report that and pay any estimated tax within 30 days of completion. There's some practicality issues with that, both in terms of online reporting and what the hell is the tax liability arising type scenario. So that just needs some thought from the outset and some early engagement with your advisor. The main one from yesterday that, again, was banded in the media quite a lot, the SDLT extension. So they've confirmed that the 500,000 limit, so someone can buy a property for up to 500,000 and not pay stamp duty. That's extended from the end of this month to the end of June, which comes a relief to everybody, I would have thought. But then from the end of June, there's a smooth transition, is their words, to that reduces down to 250 and then down to 125 from October 2021. There's also, we haven't got it on the slides, but there's also the mortgage guarantee scheme in place now for that the government are effectively saying if you're trying to buy your first house and you've only got a 5% deposit, then we will help you to guarantee those payments, etc. And it would appear many of the main high street lenders, etc., are on board with that, which is great.
So some changes to employment taxes, just to cover off here. So the national living wage rising to £8.91 from £8.72 from April 2021, and also now includes 23 and 24-year-olds. Previously it was only for 25 and over. National insurance frozen. The apprentice incentive payments have benefited as well. So the bonus for taking on new apprentices is now £3,000, which I believe is doubled. And it's also now open to apprentices of any age, rather than the age restrictions that were in place before. Off payroll workers. So this was due to roll out last April, and was deferred. So that's coming in this April, and what that basically revolves around is an aligning of the private sector with the public sector in terms of off payroll working and use of contractors. So this probably demands its own presentation itself, to be honest, but in a nutshell, the requirement to assess an individual to PAYE and national insurance contributions, the responsibility for that is now sitting with the company contracting them, rather than the contractor themselves. And that's quite important in terms of making sure that from a compliance issue, that's very important. HMRC have numerous toolkits to try and help employers identify whether or not a subcontractor should be accounting for PAYE and NIC for them, but they sort of have mixed outcomes, we tend to find.
I think the national living wage is interesting as ever. With it will squeeze the business owner even more in terms of having to pay more, but also to the more lower paid. But also what that does is also drive up the semi-skills, the 9, 10, 11 pounds an hour employees as well, because they'll want a bit more. And as businesses are trying to scale and come out of lockdown, that is just another cost, which is something else to be considering and squeezing on the employer. I think this also signifies the concept of fiscal drag, which I mentioned earlier, that the living wage is increasing, people's wages are increasing, which is great in isolation, don't get me wrong, but that will also have an impact on tax payable, etc. Dan,
sorry, Rob, we had a question. I saw somebody asked about IR35. So the off payroll workers is IR35. They're just in different terms. So yeah, no major changes there.
Dan, I'll skip through this. I'm conscious of time.
Sure.
So R&D tax credit still very much at the forefront of HMRC's minds. They're opening a consultation from yesterday to do two things. One is to effectively make it more accessible to businesses. Still too few businesses are claiming the R&D tax credits, which is extremely lucrative. And similarly, they're looking at ways in which the scheme may be seen to be abused in some way. And so they're looking at both opening it up, but also cracking down. So that's going to be interesting. I won't go into the details here. You've probably heard me talk about these previously. The key is that there's R&D is still here. It's still very much a lucrative scheme to be involved in if you can get within it. One key point here is that there is a slightly hidden cap from 1st of April 2021. So before, when a loss-making innovative company claimed R&D tax credits, they could by default surrender lots of those losses back to HMRC for cash. So they didn't need to be paying tax, they just received cash as well. There's an anti-avoidance, what is an anti-avoidance rule that caps the amounts that they can get to come back, where you've got a connected party relationship, so where you've got more than one company interacting. This isn't a particularly big thing, other than it can catch some genuine arrangements where you've got a group company. You might have one company that undertakes and pays all the staff for the whole group, whereas one company, another company within the group actually undertakes the qualifying activity, and there's a cross charge between the two. There's some, a genuine arrangements like that could potentially be caught by that. So again, needs a review. So that's the tax elements of it. And then we'd like to introduce Phil to talk through some of the COVID support updates.
Thank you, Rob. So good morning, everyone. I'm going to cover off everything that the Chancellor announced on COVID support measures. So if we start off on the job support scheme, it's been widely reported the furlough scheme has been extended through to the end of September. Key things to note are that in July, employers will be expected to make a 10% contribution, and from August onwards, that'll be 20% of the 80% that the government's covering. The self-employed income support scheme has also been extended. So for the February to April period, that will be on the same basis as before. And then through to September, there will be a new turnover test. So if your turnover has dropped by less than 30%, the amount of grant will be restricted to 30% of your average trading profits. Then there's also been the new payment for hiring new apprentices, Dan mentioned, of £3,000, so an incentive for that. I'll talk a bit about the financing schemes available. So CBILS and bounce back loans bubbles will be ending on the 31st of March as stated. There is the pay as you grow option with the bounce back loan that was announced a few weeks ago, whereby you've got the option to take some capital repayment holidays 3 times during the term of the loan and extend it to a 10-year term. What was announced yesterday was the recovery loan scheme. So this will work in a similar way through the major banks and other lenders. The government are again providing an 80% guarantee. Loans are available between 25,000 and up to 10 million. There won't be a turnover test, and you can still apply for this even if you took a CBILS or a bounce back originally, but the amount you can borrow will be at the bank's discretion, what the lending criteria is and restrictions involved. There isn't an interest-free period on this. Interest will start be payable straight away, and there's different products that it can be used against. So term loans and asset finance, a max term of 6 years, and overdrafts and invoice discounting, which is a max of 3 years. More information will be coming out in due course. We think it's probably going to be a bit more difficult to access than CBILS and bounce back, but we'll wait to hear on that. Then the other point to mention is on restart grants. So there's £6,000 grant available for non-essential retail businesses and 18,000 for hospitality, accommodation, leisure, personal care and gyms. and these grants can be accessed through the council. I think details will be going out shortly. Okay, so then the roundup of some of the other measures that have been announced. We've got the VAT deferral. So if your business took that deferral last year, that in theory will become due payable from the end of March onwards. That can be deferred to 11 payments rather than one lump sum. So just spreading out that across the next 11 months. There's also a VAT reduction to 5% for any goods or services provided by the tourism and hospitality industry. So it might be passed on to the consumer or retained. Wait to see on that. Then other measures, statutory sick pay has been extended, so up to 2 weeks can be reclaimed. There's no end date yet on that. And then business rate relief has been extended. So from the period 1st of April to 30th of June for hospitality and leisure, that will be 100%. Then it will fall to 66% relief from the 1st of July through to March 2022. There's a cap of £2 million per business for those who were forced to close on the 5th of January this year, or if you weren't forced to close, it's capped at 105,000. And then just the last point to note is the Zoo Animals Fund, so the continuing support for animal feed and maintenance for registered zoos and aquariums through to the end of June, which is nice. So that's a summary of the COVID support, and I'll hand back to Robert now to take any questions.
Thank you, Phil, and thank you, Rob, Dan, for your contributions this morning. I'm going to rattle straight into questions if we may. One which is in the chat there is from Andrew Wood. Did I hear mention of a CT ratchet rate between £50,000 profits at 19% and 250k at 25%?
Yes. So without getting into too much detail, then we've got, so from April 23, you've got 19% for the first 50. Then you've got for the anything above 250 is 25%, and anything in between is actually going to be a marginally higher rate than 25. And the reason that is when you look at your total taxable profits and what the rate needs and what the actual effective rate is, it will be somewhere between 19 and 25. So that might sound a bit quirky, but the middle bit needs to be higher in order for the maths to work to get somewhere between 19 and 25. So effectively, the short answer is yes, there is a ratchet rate, and it will mean, and when you crunch the numbers, the total tax in that period will be a percentage of anywhere between 19 and 25%. There's a planning opportunity if you've got a group of companies whereby you have some losses, and what companies do you give the losses to by way of group relief? And it's a bit of a batting order that you want to take people out of that marginal rate amount first, because that's in isolation the highest, and then you apportion them elsewhere to anything over 250, if that makes sense. So we're actually going, as Dan alluded to, we're going back to 5-6 years ago plus. So many tax advisors are learning this for the first time, and it's some people with a few grey hairs are saying, I remember this in my time, etc. But yeah, so much for simplification anyway.
Thanks, Rob. Thank you for that. We did cover Michael Doolan. Thank you for that question. We did cover the answer to that with regards to IO35, so that's great. Gary, I can't do coffee and bacon sandwiches, but we can certainly get the slides to you, so don't worry about that. That's fantastic. If anybody doesn't want to type, if there's any questions where you want to put your hand up, and I will come to you. I'm just looking at both my screens at the moment just to make sure that we don't miss anybody. Question from Gary. Gary Woodman, you're just on mute. There you are. Perfect. Away you go, Gary.
The R&D tax credits, sort of through Bishop Fleming and our other professional advisors, sort of Worcestershire and Herefordshire have done really well in the past. I just wondered that review and perhaps whether there's a piece of work there for Bishop Fleming, the LEP and the Chamber, and obviously businesses to feed into that review, because I wouldn't want to lose our little bit of advantage that we can get over some other areas who haven't necessarily maxed out on the R&D tax credits. What's your thoughts?
Yeah, absolutely. So yeah, Chris and I were discussing this last night, which is, yeah, sad, I know, but we're very much think that we need to engage with it. The consultation is actually to the taxpayer as opposed to advisors. So we don't have a direct feed in because we aren't being asked the questions, but the HMRC are normally quite collaborative with the R&D regime with advisors as well. And so absolutely something that we would like to get involved with, and by working with the LEP, etc., just makes sense from our perspective as well. So yes.
Thank you, Rob. Thanks for the question, Gary. Obviously, from a chamber point of view, we'll make sure that we continue our work with that as well.
Yeah, absolutely.
Can I follow up? Because there was another consultation as well, which was about the sort of enterprise. I can't remember what it was now. That's sort of trouble. So too early in the morning for me now.
Yeah.
I used to be able to get up early and start. I can't do that now anymore. COVID has changed my working pattern. But because there was another consultation, which again I think probably particularly in relation to the let and beta den, thinking about those early stage entrepreneurs. Again, I wonder whether there's any thoughts on that.
So this is EMI. This is the tax advantage share schemes where business owners look to incentivize some key staff with some share options to get some into equity at some point in the future. The consultation, haven't looked at it in detail, but it wasn't, I think the main points around that was just clarifying what happens when someone's actually furloughed. And the revenue have confirmed that. So one of the key points to that share scheme is you need to have a working time requirement. So the individual has to be working in the business substantially in order to keep qualifying for their share option. The thought is, initial thought, if they're on furlough, which a lot could be, then they're not by default working, so they don't meet the condition and their share options are lost. So HMRC, yes, or the Chancellor yesterday confirmed that isn't the case, which is good. From a wider EMI perspective, I would struggle to see how they would want to change that in any detrimental way, because again, it's an area that is used quite widely, but probably not widely enough, and the tax impacts are really quite significant as well. Kind of answers the question, Gary.
That's good.
Great. Thanks very much, Gary. Thanks, Rob. Any other questions, folks? I'm just keeping my eye out. There's nothing in the chat.
By all means, if you do think of something, and call us or email us anytime, and we can come back and give you our thoughts. That's no problem at all.
Gary, is your hand back up, or did it not go down?
No, sorry.
That's okay.
Poor form.
Right. No, that's okay. Didn't want to miss out. I'm just checking my screen there. There's nothing there. Well, we've got a couple of minutes left, and that might give people the opportunity to prepare for their 9 o'clock Zoom or their Teams meeting at 9 o'clock. So I would like to extend a big thank you to Rob, Dan and Phil, to Emily also at Bishop Fleming for all their help with this particular event this morning. We, as I said at the beginning, chamber events are only as good as the people who contribute towards them and the people who attend them. And so it's a big thank you to you all for attending, and to the chamber team for getting us all together also. I would hesitate to say with the frozen theme that if there's anything that the Chamber are asked to lobby on, we quite promised you that we will never let it go. But with that particular point, we may well be best to finish up. So ladies and gentlemen, have a good Thursday. I hope your Zooms go well. And